Welcome to Executive Outcomes YouTube channel. My name is Michael Mwansalioba. I'll be taking you through financial reporting conceptual framework part 2. To cover this particular session are the following: conceptual framework for financial reporting, purpose of framework, scope of conceptual framework, overview of conceptual framework. We answer the question of why regulate financial reporting. We look at the role of regulating bodies. We also look at the consequences of absence of regulation. And finally, look at why should we adopt international financial reporting standards. Conceptual framework for financial reporting. This can be described as a foundational document that guides the development of financial accounting standards and enhances the transparency and comparability of financial statements. It provides a coherent and consistent set of concepts and principles for preparing and presenting financial statements. Therefore, the conceptual framework helps regulate accounting practice. How can we put the purpose of framework in this case? The framework purpose is to assist the International Accounting Standards to develop and revise its standards. Secondly, to assist entities to consistently develop accounting policies when no standard applies to a particular transaction or other event, or when a standard allows a choice of accounting policy, and also is there to assist all stakeholders to understand and interpret the standards. What does the concept of or the conceptual framework scope look like? The conceptual framework for financial reporting covers a number of areas. Some of them we have already covered in part 1, but I'm going to repeat them just for your sake. We are looking at, in this regard, objective of general purpose financial reporting. We look at qualitative characteristics of useful information. We look at financial statements and reporting entity. We cover elements of financial statements. We look at recognition and de-recognition. We look at measurement. We look at presentation and disclosure. We also look at concepts of capital and capital maintenance. This is all that is covered under conceptual framework of financial reporting. I gave you an overview of conceptual framework as follows. Conceptual framework can be taken to be a statement of general accepted theoretical principles that forms frame of reference for financial reporting. You may wish to know that financial statements are produced worldwide, and their main purpose is to satisfy requirements of external users. Now, over time, we have realized that there have been variations in practice which have resulted from different social, political, economic, and legal aspects of each country. In this regard, it makes comparability or usefulness of information quite a challenge. And therefore, the International Accounting Standard Board came on board and is there to harmonize all aspects of financial statements so that they can be comparable and become more useful. In this regard, The conceptual framework is created to set up concepts that underlie preparation of financial statements to achieve uniformity and harmonization. Why regulate financial reporting? Can we, for once, imagine if there was no financial reporting that is regulated? If financial reporting was not regulated, there will be a lot of chaos. There will be a lot of misleading statements prepared. So in this regard, we need financial reporting to be regulated. To this effect, we can say it is important to ensure that an entity adopts accounting treatment that is consistent in preparing financial statements that provide information that is useful to a wide range of users to assist their decision making. That comes to another aspect. It brings out to look at the role of regulatory bodies. Amongst other roles, they are chiefly there to set accounting standards to ensure that the entities adopt similar accounting treatment for similar items and account for similar transactions in the same way over time. Also, this makes it possible to compare the financial statements of different entities and to compare an entity's performance for the current period with that of the previous period. Again, if you had to stop for a moment and look at the consequences of absence of regulation, amongst other things you will come up with is one, you find that management would adopt whichever accounting treatment that presented its results and position in the best possible light. Secondly, management can deliberately mislead the users of financial statements. So we can see that the stewardship function cannot be serving its purpose. The next thing we need to look at is the need for international financial reporting standards. The following are some of the reasons why it's important to adopt international financial reporting standards. This includes one, they are widely accepted as a set of high quality and transparent global standards to achieve consistency and comparability across the world. The other reason why they are favored is that they are produced with cooperation with other internationally renowned standard setters with the aspiration of achieving consensus and global convergence. Furthermore, companies that use financial reporting standards and have financial statements audited in accordance with international financial reporting standards will have an enhanced status and reputation. Further, International Organization of Securities Commission recognize international financial reporting standards for listing purposes. It can also be argued that it is easier and cheaper to raise finance on international markets for those that have adopted international financial reporting standards. Again, companies with foreign subsidiaries will find process of consolidation simplified if all subsidiaries adopt international financial reporting standards. Also, it enables accounting staff to be transferred between group companies in different countries. Furthermore, companies that adopt international financial reporting standards find their financial statements easily comparable with other companies that adopt international financial reporting standards. Therefore, this can obviate the need for any reconstruction from the local, generally accepted accounting principles to international financial reporting standards when analysts assess performance. This marks the end of Conceptual Framework Part 2 for Financial Reporting. Please don't forget to subscribe to my channel and like my channel. We'll meet next in Conceptual Framework Part 3. Thank you for listening.